You think capital allocation is purely about IRR and NPV. Well, highest returns wins, always. End of story. That's the reality. I think everyone agrees with me, right? But what if a project with the highest returns is also carrying the highest ESG risk? And what if that risk silently changes your cost of capital, your financing access, and your long term valuation? Because here's the truth: ESG doesn't just influence reporting, it influences which projects get funded and which ones don't. And thank you everyone for coming on board with me in a new video. This is Diego, and I'm talking from the clinic, your go-to destination for everything corporate finance, accounting, FP&A, insurance, everything finance related more to the strategic decision-making side of things. In the previous videos, we've covered ESG fundamentals, carbon markets, valuation impacts, and how to communicate ESG metrics to executives and boards. Today, we are going a bit deeper, once again, as we should, into something even more powerful, which is how ESG reshapes capital allocation and investment prioritization. To kick things off here, the first question should be addressed, the first point should be addressed. Why ESG changes capital allocation? Every company operates with limited capital. That's the reality, right? I think everyone agrees with me on this point. And there are always more projects to be funded than funding available. So management must decide what gets approved, what gets delayed, what gets rejected. Traditionally, those decisions are made based on IRR, net present value, payback period, strategic alignment, just to name a few. But ESG introduces a new layer per se on this, which is the risk-adjusted return, okay? Because ESG risks affect cash flow stability, regulatory exposure, insurance costs, financing conditions, reputation and revenue durability, just to name a few things here. And once those risks are priced correctly, the ranking of projects can change drastically. Now, second thing to be addressed, how ESG influences prioritization. Let's break these into three practical mechanisms. First mechanism here, ESG impacts cost of capital. Companies with higher ESG risk often face higher debt spreads, stricter lending conditions, reduced investor appetite as well. So, if your cost of debt increases, your WACC also increases. And when WACC increases, your NPV, net present value, of your projects are going to decrease. Two projects with identical projected cash flow can have completely different valuations once ESG risks are factored into the discount rate. Capital doesn't just flow to returns. It flows to risk-adjusted returns. The second point, ESG alters cash flow assumptions. Environmental risks can affect carbon pricing, exposure, regulatory penalties, asset write-downs, physical damage from climate events, something that we can see everywhere nowadays, and social risks, right? The social aspect of it affect brand erosion, customer churn, labor disputes, When we go to the governance risk, we can see it affecting fraud, probability, strategic misalignment, capital misallocation. When these risks are modeled properly, projected cash flows change. And when cash flows change, prioritization changes. The third thing here to be highlighted. ESG influences access to capital. This is the part many finance professionals underestimate, okay? Capital markets increasingly integrate ESG screening, and that makes sense to do so. Some investors won't fund certain industries. Some lenders price sustainability-linked loans differently. Some institutions tie financing costs to ESG performance targets. This means, basically, that even if a project looks financially attractive internally, external capital constraints can limit its feasibility. ESG doesn't just adjust valuation. It's just how it is. It determines whether funding is available at all. And I'll just bring a real life example here. As always, I'll try. Imagine two investment proposals. The option A is a traditional production line, 15% IRR, high carbon intensity, and the option B is modernized sustainable line with 13% IRR, lower emissions, and a better long-term compliance profile. In the old model, option A wins for sure. It has the best IRR, right? 15%. But once you factor in future carbon pricing, potential regulatory tightening, and a higher insurance premium, maybe even higher financing spreads as well, then the effective return of option A compresses drastically, right? And option B becomes superior on risk-adjusted basis. That's not ideology, okay? That's what I want you to understand here. That's not ideology. That's capital discipline. And everyone is getting, the market is adjusting their way. We cannot be out of this game. So ESG doesn't eliminate projects. It reprices them. And finance professionals who understand how ESG affects capital allocation are the ones influencing real strategic decisions. So be on this boat. Try to get to that point. Because at the end of the day, strategy is simply capital allocation under uncertainty. So yeah, subscribe to the channel and stay tuned for next videos coming. And if you have any, ideas on ESG related topics, green finance, anything related to that, or even, topics outside of ESG that I will be exploring as well, feel free to highlight them in the comment section down below. Share the content as much as you can so that you help me continue producing them. And I hope you take some value out of this. That's the purpose of doing this, to help people and, share the journey, craft, sharpen our craft together. That's what I've created this for. And I hope you guys come along with me. So like, subscribe, hit the bell icon so that you are covered with everything that we'll be dropping here. Thank you so much for today. Cheers. Bye.